The correlation between physical effort and wealth is not merely weak. In the modern financial system, it is often inverse. To understand why working harder fails to produce wealth, we must examine the structural divergence between labor and capital. Labor is an asset that is sold in units of time. Because time is a finite, non-renewable resource, labor-based income is inherently linear. Even if an individual increases their hourly rate through specialization, they remain capped by the 24-hour day. Wealth, conversely, requires decoupled growth, where output is not tied to the physical presence or active hours of the owner. In most labor markets, the law of diminishing returns applies to effort. The first 40 hours of work produce a base income, but the incremental value of the 50th or 60th hour often yields less value due to fatigue, higher tax brackets, and opportunity costs. In a capital-based system, the marginal cost of generating an additional dollar of profit from an existing asset is nearly zero. Inflation acts as a systemic tax on labor. While wages are sticky and slow to adjust to monetary expansion, asset prices, such as real estate and equities, react quickly. Therefore, a worker's savings, derived from labor, lose value relative to the assets they are trying to acquire. The goalpost for wealth moves faster than the worker can run. Economist Thomas Piketty identified that when the rate of return on capital, R, is greater than the rate of economic growth, G, wealth concentrates in the hands of asset owners. Since labor is tied to economic growth, G, and investments are tied to capital returns, R, those who rely on work alone will mathematically fall behind those who own the means of production. Labor cannot be replicated without cost. To double your labor output, you must double your hours or your staff. However, capital-intensive products, such as software, debt instruments, or intellectual property, can be replicated at a near-zero marginal cost. This scalability allows for wealth generation that is divorced from any physical input of work. The structural design of most tax jurisdictions favors capital over labor. Progressive income taxes penalize high-earning workers, while capital gains and corporate structures allow for tax deferral and lower effective rates. A worker paying 35% on their time is at a permanent disadvantage against an investor paying 15% on their dividends. Labor is subject to global competition and automation. The cost to replace a human worker is constantly trending downward due to algorithmic efficiency and global labor arbitrage. Assets do not have a replacement cost, they have an acquisition cost. While labor is being devalued by technology, the technology itself becomes an asset for the wealthy. Wealth is the reward for owning risk, not for performing tasks. Workers are paid to minimize risk for the employer, for which they receive a fixed wage. The surplus value created by the worker, minus the cost of risk, is captured by the owner. Without the mechanism of ownership, the worker is excluded from the upside of the value they create. The final barrier is the feedback loop. Capital allows for the acquisition of more capital without further labor. This creates a self-reinforcing cycle where the wealthy can afford to wait for long-term gains, while the worker must liquidate their time immediately to meet subsistence costs. This time preference gap is the ultimate wall. Working hard is a prerequisite for survival in a labor-based economy, but it is not a mechanism for wealth. Wealth is a function of leverage, specifically capital, scalability, and ownership. Until an individual moves from selling time to owning assets, they remain a component of the system rather than a beneficiary of it. The math of the system is indifferent to effort. It only respects the efficiency of capital.